You've probably heard the phrase max fund your IUL, but almost no one explains what that actually means or how to avoid the tax traps that quietly sabotage 99% of these policies. Here's the uncomfortable. Last month, I reviewed a policy for a cardiologist who thought he was building tax-free wealth. After contributing $50,000 per year for the past 3 years, I discovered he was just $2,000 away from triggering a tax disaster that would have cost him over $400,000 in future retirement income. And in this video, I'll show you exactly how the top 1% design their IULs to legally grow and access tax-free income without triggering a Modified Endowment Contract, also known as MEC, without giving up liquidity, and without the devastating mistakes that destroy most policies before retirement. Now, if you're earning over $150,000 per year and you're tired of watching the IRS take 30 to 40% of everything you work for, here's exactly what you'll discover in the next few minutes. You'll finally understand what a MEC-funded IUL really is and why it performs completely differently than the watered-down policies most people are selling. You'll see the exact strategy used by executives and small business owners to legally eliminate taxes on retirement income while staying 100% compliant with IRS rules. You'll learn the 3 expensive mistakes that cause IULs to collapse, including the 2000 error that nearly destroyed my cardiologist client's entire plan. And you'll discover how to access your money tax-free for the next 20 to 30 years without triggering penalties, without RMDs, and without the IRS touching a single dollar. Plus, I'll reveal the one design flaw I find in 9 out of 10 policies I look into that instantly kill tax-free growth. Something most agents don't even understand. When you get to that part, you'll see why this single mistake has cost Americans billions in unnecessary taxes. Before we dive in, hello, my name is Robert Balgach. I'm the founder and CEO of Black Swan Insurance Group. To be honest with you, when I first started in this business back in 2017, I also made a critical mistake with my own IUL policy. I really thought I understood how these policies work, but I was wrong. And that mistake cost me 2 years of optimal growth and taught me exactly what separates policies from building tax-free wealth from policies that destroy. Since then, we'll help over 20,000 families design IUL strategies that actually work, not just on paper, but in real retirement plans delivering real tax-free income. We have reviewed thousands of policy illustrations, seen what causes them to fail, and more importantly, discovered how to structure them for decades of tax-free income without IRS penalties or hidden fee traps. And what I'm about to show you isn't just theory, it's a battle-tested strategy used by doctors, corporate executives, and small business owners who refuse to gamble their retirement on market volatility or government tax policy. What exactly is a MEC-funded IUL? Most people think it's life insurance, but here's what the wealthy understand that everybody else misses. A MEC-funded IUL isn't just life insurance. It's a tax-advantaged wealth strategy disguised as a life insurance policy. Here's what makes it completely different. Instead of maximizing the death benefit like traditional life insurance, a MEC-funded IUL is engineered to maximize cash value growth while keeping the death benefit at the legal minimum. Think of it like this. Regular life insurance is like buying a mansion when you only need a studio apartment. You're paying for space you don't need. A MEC-funded IUL gives you exactly what you want, maximum growth space at the minimum cost. Inside a policy, something remarkable happens. Your cash value grows tax deferred and is linked to the market index performance like the S&P 500 index. But unlike your 401k or brokerage account, your money is never at risk. When the market soars 20%, you capture cap gains, often 10 to 12%. And when the market crashes 30%, you don't lose a penny, thanks to the built-in 0% floor. Imagine this. It's March of 2020. The COVID lockdowns were just announced, and the market just dropped 35% in 3 weeks. Your friends are watching their 401ks evaporate, but your IUL statement shows 0% loss. Not a single dollar disappeared. And that's the power of downside protection. This creates what high-income professionals call the rich person's Roth, because you get no income limits, unlike Roth IRAs, no contribution caps, unlike 401ks, and Roth IRAs, no required minimum distributions, unlike traditional retirement accounts, and there is no IRS waiting to tax you later. But here's where most people get destroyed, and it's coming up next. There's one IRS rule that can turn this tax-free strategy into a taxable nightmare overnight. Miss this, and everything I just explained becomes worthless. Now, I know what you're thinking. You probably have a dozen questions about how this actually works for your specific situation. Should you move money from your 401k? How does this affect your current tax strategy? What if you're already 50 years old? And that's exactly why I created something special for you. I built a IUL custom GPT. It's an AI-powered assistant that has all my knowledge about IULs, tax strategies, and retirement planning built right in. It can answer your specific questions instantly, whether it's about contribution limits, tax implication, or how this fits with your current financial plan. Think of it as having me available 24/7 to answer any IUL questions you have. I'll drop the link in the description below so you can get your questions answered while we continue. But first, let me show you the one IRS rule that can destroy everything we just discussed. How MEC's funding works. This is where 99% of IULs fall apart and where the top 1% separate themselves from everyone else. Remember that cardiologist I mentioned? Here's exactly what almost destroyed his plan. He's been contributing $50,000 per year, thinking more was always better. But the IRS has a trap waiting for people who think like that. You cannot just dump money into a life insurance policy and call it tax-free. The IRS has rules. And if you violate them even once, your entire strategy explodes. The most dangerous rule, the 7-pay test under IRS section 7702A. Here's how it works. The IRS limits how much you can contribute over the first 7 years. Cross that line, even by $1, and your policy becomes a Modified Endowment Contract, also known as MEC. And once it's a MEC, everything changes. All your policy loans become taxable. You lose tax-free access to your money. And if you're under 59.5, there's also a 10% penalty, just like a 401k. You've taken what could have been decades of tax-free income and you turn it into a taxable liability. My cardiologist client was $2,000 away from this disaster. $2,000 from destroying $400,000 in future tax-free income. That's how precise this has to be. So here's how the wealthy fund their IULs without ever crossing the MEC line. They design with the lowest possible debt benefit that qualifies under IRS rules, maximizing the MEC limit. They start with the debt benefit option B during funding, so the debt benefit grows with cash value, creating more contribution room. Then they switch to the option A after funding, capping the debt benefit and minimizing future cost of insurance costs. It's not accidental. Every dollar is strategically placed to stay right under the MEC line while compounding tax deferred for decades. When engineered correctly, you get full IRS compliance, maximum liquidity, and decades of tax-free income without the government clawing any of it back. But even perfect compliance means nothing if your money isn't growing efficiently. And that's where most people get their next shot. How the cash value actually grows. So let me ask you something. Have you ever wondered why your money actually grows inside these policies? Because what most agents tell you is, and what actually happens, are two completely different things. Your cash isn't invested in the market. That's the first thing people get wrong. It's linked to a market index using a credited method built for one thing, protecting your downside while capturing reasonable upside. Here's what it actually looks like. When the S&P 500 index goes up 25%, you earn cap interest, typically 9 to 12%. When the market crashes 30%, you earn zero. No negative, just zero. Think of it like a ratchet on a mountain climb. You may pause at the ledge, but you never slide backwards down the cliff. You just keep going up. Here's the part that changes everything. It's called the annual reset. So each year your gains are locked in permanent. So even if the market crashes the next year, you don't need to recover like everyone else. You simply stay flat and start the next year from a higher baseline. Let me show you what this looked like during 2008 financial crisis. While the S&P dropped 37% in 2008, and it took roughly 5 years to recover, The properly structured IUL earned 0% in 2008 and then start earning positive returns immediately in 2009 while the market was still recovering. No sleepless nights, no watching your retirement disappear, no wondering if you'll ever recover. This makes it perfect for people who want steady, tax-deferred growth without market risk, protection of previous gains during market crashes, and a peace of mind that their retirement income is secure. But here's what shocked me after reviewing thousands of policies. The company name on your policy matters far less. That's something most people never even consider. And this next point could save you from the most expensive mistake in the IUL world. Why design trumps everything? One of the first questions people ask me usually is, hey, Rob, what company should I get my IUL from? And while carrier strength matters, here's the uncomfortable truth that could save you hundreds of thousands of dollars. It's not the logo on your policy that determines your results. It's the design under the hood. And just last week, I reviewed 2 policies, both from A-plus rated carriers, both for $50,000 annual contribution. And the first policy was projected to provide $4,200 per month in tax-free retirement income. And the second one, only $2,800 per month. Same premium, same carrier rating, but a $1,400 per month difference in retirement income. That's $16,800 per year, and over 20 years of retirement, that's $336,000 in lost income, all because of the poor design. You could have chosen the strongest carrier in America, but if your policy has a bloated death benefit eating your cash value and underfunded premiums that barely keep it alive, no strategy for tax-free income distribution. No ongoing management after year 1. You'll end up with a policy that underperforms, gets taxed, and collapses right when you need it the most. But when designed correctly, you'll have a lean, efficient, death benefit minimizing insurance costs, maximum contributions right up to the MEC line, strategic option B to option A, switch after funding, planned loan strategy for decades of tax-free income, annual reviews and optimization like any other high-performance asset. So when someone tells you IULs don't work, they're usually right about their policy. Because IULs don't fail, poor design fails. And that brings me to the comparison that will make everything crystal clear. Regular IUL versus MEC-funded IUL. Let me show you the difference between what most people get sold and what actually builds generational wealth. Because what I'm about to show you explains why some people call IULs the best investment they ever made, while others call them the worst financial mistake of their lives. Regular IUL has a common flawed design. I recently met with a 55-year-old executive who's been sold a premium IUL from a major carrier, and after 12 years of $25,000 annual contribution, $300,000 total, his cash value was actually declining, and the policy was about to collapse. Here's what went wrong. Focused on maximizing death benefit, creating massive insurance charges, funded with minimal premiums, just enough to keep it breathing, so the cash value grew slowly and then stalled completely. No loan strategy, no reviews, no plan. He came to me panicked, asking if he should just surrender the policy, take a massive loss, or keep funding it a sinking ship. 12 years of contributions, and he was worse off than if he had done nothing. Compare that to the client we designed a policy just 3 years ago. A small business owner contributing $60,000 annually. His cash value has grown every single year. He's already taken $45,000 in tax-free loans for his daughter's college. And he's on track for $12,000 monthly in tax-free retirement income. And here's what we did differently. We minimized the death benefit to maximize growth efficiency. We funded up the legal IRS limit without triggering MEC. And we also reduced the insurance costs through strategic design, built-in downside protection with upside participation. Created a 30-year tax-free income plan with annual optimization. Same concept, same tax code, but one was slapped together with a brochure while the other was engineered to last a lifetime. So when people say IULs don't work, they're not wrong about badly designed policies, but a properly MEC-funded IUL built right for the right reasons can completely transform your financial future. And that brings me to the next step. If you're earning $150,000 or more, and you're serious about building real tax-free retirement income, here's what I know after helping 20,000 plus families. The people who take action on this information in the next 30 days are the ones who retire with true financial freedom. The ones who wait until next year are still waiting, and they're still paying taxes on everything. So we've created something called the Tax-Free Wealth Blueprint Strategy Call. It's a personalized strategy session where we'll just understand what you're looking to achieve, and also we'll figure out how to design your exact plan, how to max fund your IUL based on your specific income and goals, how to legally avoid every tax trap that destroys 99% of the policy, and also how to turn that policy into 30 plus years of tax-free income with no RMDs, no capital gains, and no IRS interference. And this isn't a generic webinar or sales pitch. It's a one-on-one session, custom built around your numbers. We only take on clients we can genuinely help, and we build these plans by hand. So you can click on the link below to book your strategy call, and spots are limited. Not ready to book the call yet? I get it. This is a big decision. Then watch this next video right there. It walks through a recent case we designed for a chiropractor, showing exactly how $1,000 monthly contributions are projected to generate over $3,500 monthly in tax-free retirement income. You'll see the funding timeline, the compounding growth, and how tax-free income is created step by step. So you've got two options. You can follow the herd, max out your 401k, and hope taxes go down. Or you can learn how the top 1% design policies that create permanent tax-free income and take control of your future. Because in the end, it's not what you make, it's what you keep. Enjoy the ride.